beginning with exercise 15. This company has direct materials of $2 per unit, direct labor of $3 per unit, manufacturing overhead of $1 per unit, 35,000 in fixed costs. We need to come up with budgeted amounts for 20,000 units and 25,000 units. Okay. Well, let's put in the fixed overhead first. Says fixed costs are 35,000, so that must be the fixed overhead they're talking about. And that would be the same under both scenarios, right? Because they're fixed costs. So how do we figure out our variable costs based on 20,000 units of production?
Add over per unit costs.
Okay.
Multiply by the amount of units.
Okay, that's right. So if we take our direct materials, which is variable, $2, direct labor, also variable, $3. And then manufacturing overhead, we can assume that's the variable portion of $1. So together that's $6 of cost per unit, right? Multiply that by 20,000 units. And we get $120,000 of variable production costs. And then we add that to our fixed overhead, and we get total costs of $155,000. If we take our $6 per unit cost times 25,000 units, that's 150,000, right?
Yeah.
And then we get a total of 185. Okay, that seems too easy, but let's check it. Okay, 15. Oh, that's it. 155,000 and 185,000. Okay, so ready for our last, I think it's our last exercise. Yep. You ready? Oh yeah, this one's interesting. So we have this information here. There are 3 different types of costs. They're just labeled A, B, and C. And we've got 2 different production levels. We need to make a flexible budget based on 17,000 units. Okay. So starting with expense A, what is our per unit cost of expense A? Okay, and how'd you get that, Zay?
15,000 divided by the 10,000 units.
Okay, you take the $15,000 of costs for expense A divided by the 10,000 units that was based on. Yeah, you get $1.50. Or you could also do that over here. You could take the $22,500 of cost for expense A divided by the 15,000 units that was based on. You also get $1.50. So we see clearly expense A is $1.50 per unit. So then, so we can put that right here. So then how do we get our total cost based on 17,000 units? Multiply by 17,000. And we get 25,500. Okay, does that make sense to everybody? All right, how about expense B? Okay, that's true. That is the cost per unit at 10,000 units. But it's fixed, right? So we actually don't even need a cost per unit in this case, because we see at both levels of production, it's $21,000. And same thing with expense C. Those are both fixed costs. So they kind of tricked us. There is no, I mean, there is a per unit cost, but it's not relevant. So we're just going to put $21,000 for expense B and $43,000 for expense C. Add it all up. And we get $89,500 of total expenses or 17,000 units of production. Okay. And then we already did 17. Questions on the exercise sets? All right, then, let's move on to the problem set. There are quite a few for us to do. Did we do any on Tuesday? Anybody remember?
Yeah. I think some is more.
We did 4? Okay. Yeah, did 4. Okay, so we won't do 4 again then. And we just did one problem today, right? 11? Okay. All right, but let's go ahead. We've got 6 others. Ooh, some of them are a little time consuming, to be honest. So, does anybody need a break at this point? No? Okay, we might be able to finish within half an hour or so. So if it gets to be too much and we need a break, let me know. Okay, this first one is a bit time consuming because we're going to make a sales budget and a production budget and 2 materials budgets because we have 2 types of material and a labor budget. This is a 2-page exercise problem. Okay, so hang in there. This company makes contact lenses that sell for $45 each. I guess that's for a pair, I'm assuming. They're estimating 15,000 units of sales. January, 18,000 in February. There are 2 ounces of silicon in each one, which costs $2.50 per ounce, and 3 ounces of solution, which costs $3 per ounce. It takes 30 minutes of direct labor. I guess that's per unit. And the labor rate is $18 per hour. They also gave us a table here, which tells us beginning inventory for finished goods and for both of the raw materials. Okay, so we start off with the sales budget. What are our expected sales in January? 15,000. And then February, it says 18,000, right? Okay, what is our sales price per unit? 45, okay. That does not change, it's the same both months. So now we can just multiply to get our sales revenue. And then to see the total for both months together, we could just, of course, add them. And it looks like $1,485,000. Okay, let me double check that one before we go any further. Yep, okay. Not bad so far, right? So expected sales in units. Well, we already have that, right? So for our production budget, we're just going to copy our expected sales down to here. And then desired ending inventory. It didn't say anything about that. Or did it? How can we figure out our desired ending inventory for our product? Yes, if we look at the beginning inventory for the next month, that'll tell us the ending inventory. Good job, Ellie. So First, we want desired ending inventory in January would be beginning inventory in February, right? So beginning inventory, February, finished goods is 4,900. And then February's ending inventory is going to be March's beginning, which is 5,000. Make sense? So that means we need 19,900 units for January, and we need 23,000. Yep, okay, 23,000 for February. But we can subtract our beginning inventory, which again, if we go up here, we have January 4,500, February 4,900. Subtract those. And we can add together required production for both months. So that looks like 33,500 is the total we need to produce for those 2 months. Check that as well. Okay, good. Now remember the zigzag pattern I was talking about when you get into desired beginning and ending inventory? So we see it right here because January's ending inventory is February's beginning inventory. Right? Okay. Any questions so far? Dick?
So December's ending would be 4,500 because it's the beginning for January.
Yes. January's beginning inventory would have been December's ending. And there might be some problems where you have to use that sort of logic to come up with the answer. Great, okay. Shall we move on to the direct materials budget? We're going to start with the silicon. And the first thing we need to put is how many units of product to produce. So what do we put there? What was that?
15,400.
Okay, exactly. So Drew pointed out, we've got required production that we just calculated is the same as units to be produced. Just bring that down. Direct material per unit, they told us up here.
14.
Well, we'll put 2 because it's 2 ounces of silicon. We'll get into the cost later. Right now, we'll just stick with units because now we're dealing with units of materials, right? So this is how many finished good units we need to produce of our product. But each of those will take 2 units of materials, and in this case, a unit is an ounce of
But it
material.
also says it takes 3 ounces of solution.
Yes, we're going to do that one separately.
Oh,
Yeah, there'll be a separate budget for that. Okay, so then we can multiply here. If we're making 15,400 units of product in January, and it takes 2 units of material, that is 30,800 units of material for January. Make sense? And February, we multiply by 2, we get 36,200 units of material.
we need a separate budget for each material.
Mm-hmm. Yep. Yep. Okay, that looks good. All right. So now we need desired ending inventory for materials. If you remember back on this table up here, they tell us, and we'll use the same logic that LV pointed out, our ending inventory for January is beginning inventory from February, right? So it's going to be 9,100 and 9,200. So that's how much additional inventory we want to have at the end of the month. So how do we get the total material required?
Subtract the segment to be added.
Add it. Yep. Because it's saying for this month's production, we need this much, plus we want to have this much left over, so we have to add it. But beginning inventory is what we already have, so we have to subtract that so we don't buy more than we need, right? Okay, so beginning inventory for January and February, again, we can go up. We got to make sure we're looking at the right line. Direct material silicon, 8,500 units and 9,100 units. Again, we're going to subtract the beginning inventory. Now we know how many units we need to purchase of materials for that month. And so remember, we're adding the ending inventory, we're subtracting the beginning inventory. Since this is such a long exercise, I want to make sure I don't give us a wrong number somewhere. So 31,400, 36,300. Okay. Now that we know the total number of units of materials we need, we can multiply by the cost per ounce. Is that $2.50? $2.50 per ounce for the silicon. Okay, so $2.50. That's the same each month. So we get 90,750 for February. 78,500 for January. And we can add those together. 169,250. Okay. Tedious, but hopefully it makes sense. Any questions on this first materials budget? All right, well then let's move on to our second materials budget. Same concept, just the numbers are a little bit different. So units to be produced, is that going to be the same for our finished goods? Yes. You can just borrow that from up here. Direct material per unit. It's 3 ounces for the solution, right?
Yeah.
Okay. So then we multiply 46,200 is how many we need for January production. 54,300 for February. Again, we can go up and get our desired ending inventory. That'll be February's beginning and March's beginning. Yeah, 12,000 and 13,000. Very good. All right, and what do we do with that number, Zay?
We added.
Add, exactly. 8,200. 67,300. Did I do that right? And we need to get our beginning inventory. We want to take a little shortcut. We know that January's ending is going to be February's beginning, so we can just put that in there. But let's get the other one, January's beginning. And that is I went, where is it? Oh, there it is. 11,200. Okay, and now what do we do? Track, right? Okay. Cost per ounce, is it $3 on the solution?
Yeah.
Okay, and that again stays the same both months. Now we can multiply. Looks like 141,000 in January. 165,900 in February. And, oh, that's not right. I must have hit multiply by mistake. 306,900 total. Okay. All right, so we finished our 2 materials budgets. Any questions on that? Okay, all right. So let's go on to labor. Units to be produced. Is that going to be the same units to be produced we had up here? It is. So that number from the production budget goes on the materials budget, and it goes on the labor budget, and you'll see it on the overhead budget as well. Okay. How many direct labor hours are there per unit? 0.5, right? Half an hour. So we take the units to be produced times 0.5, we get 7,700 for January. 9,050 for February. And then what is our cost per hour for labor? 18. Okay, and again, that remains the same in both months. Now we can multiply. Then we add to get our total for both months combined, and looks like $301,500. Okay, great. So we did sales, production, direct materials for 2 different materials, and we did direct labor. And that concludes that problem. Are we ready to move on? Okay, so next we're going to do number 2. Going to make a budgeted income statement for March. This one's not too hard, but they do throw a couple twists in here. Sales are expected to increase each month by 10%. Okay, that's important. And we need to make a budgeted income statement. Okay. So it says the estimated sales are $560,000. For some reason, they gave us actual sales, but they don't want us to use it for this particular problem. So let's just ignore actual sales. Oh, let me think though. Let me think. 560,000. This is March. Or yeah, okay. Yeah, so this one is the instructions aren't super clear, but that's why we're going through it together. So the next thing we need is beginning inventory. how can we figure out what our beginning inventory should be?
By sales, 10%.
Okay, exactly. So like Renee said, if we take our sales, we know our ending inventory is 10% of the next month. That means our ending inventory from last month would be 10% of this month, which means our beginning inventory is 10% of this month.
Would you use actual sales or?
Yeah, we're going to base it on the estimate. Well, now that I say that, let's make sure before we get too much farther along. Yeah. Okay. Okay. Does that make sense to everybody? Since we're doing March, February's ending inventory would have been 10% of March. And that would also be March's beginning inventory. All right, then purchases, they give us here 294,823. So if we add beginning inventory plus our purchases, that will give us the cost of goods that were available for sale. 350,823. Okay, now we have to figure out ending inventory for March. So that means we need to know April's sales. So we could then take 10% of April, right? How do we figure out April sales? Okay. We take our March sales of 560,000 times 1.1. So that's a 10% increase, right? Because it says here sales are expected to increase each month by 10%. So that means that April sales, we can project to 616,000. We could take 10% of that for our ending inventory, right? Because ending inventory is 10%. So 61,600 is our ending inventory, right? We took our sales times 1.1 so that we can add 10% to get next month's sales, and then times 0.1 so we could get our ending inventory. Any questions on that? Okay, so then what was our cost of goods sold? How do we get that? Okay, that's right. So the cost of all the goods that were available for sale minus whatever didn't get sold gives us the cost of goods sold. So 289, 223. And then how do we get our gross profit? Okay, sales minus cost of goods sold, 270,777. Okay. All right, then we can move on to operating expenses. It says administrative salaries are 50,320. Marketing, it says, is 5% double star, so 5% of sales. Take our sales times 5%, and we get 28,000. Sales commissions, it says, equal 2% of sales. 11,200. Rent expense, 7,500. Depreciation is 1,100. And utilities are 2,500. Okay. So we can then add up all of these operating expenses to get our total operating expenses. $100,620. All right, then how would we get our income from operations?
Gross profit minus the operating expenses.
Yep. So take our gross profit minus this total operating expenses. That gives us 170,157. See how we're doing so far. Okay, that's good. And then it says income taxes are 15% of income before taxes. 15% of the number we just calculated. So that's 25,523.55. I think in this one, they do not round off. And so if we subtract that, you get 144,633.45. Okay. Any questions?
So for questions like this, where it ends in a decimal,
Mm-hmm.
would you say it's best to assume it doesn't round or to assume it does round?
I would say assume it doesn't and go ahead and go out 2 places past the decimal point. And there should be a Canvas should allow for a rounding error. I've tried to make sure anything that where there might be rounding, that there's a cushion there so that you're not penalized if your calculator rounds it differently or you didn't round it at all. But in general, I would go two places past the decimal point. And if you find that Canvas is marking you wrong and you think that you actually got it right, just let me know and I'll take a look. Okay, any other questions? So let's just do a welfare check here on everybody. We've got 9, 14, 15, and 16 to go. 2:17. Do we want to take a 5-minute break? We want to keep going. How many people could use a break? No, you're troopers, huh? Okay. 9, 14, 15, and 16. All right. All right. If you change your mind, let me know. But oh yeah. This one's interesting. Okay. So this is one where we have to figure out the cash collection schedule. Let's start with the easy part. Here they give us sales for these 6 months. We don't have a place for October, so I'm just gonna start with November and put in the sales amounts. Oh, I got that wrong. 8. Boom. Okay. I got that right. And then what we have to do for the first part is look at each month and figure out how much would we be collecting. 65% of sales are collected in the month of the sale. 25% the month after, and the remaining 10% the second month after the sale. Okay? So in January, we're going to collect 65% of January. In January, how much of December will we collect? January, we will collect 25% of December, right? And then in January, how much of November are we going to collect? 10%. That's right. Okay. Take a look at this one so far. That's problem 9. All right. Let's see. 570. Okay. Yeah, looks good. Okay, so then we'll repeat that process for February. So in February, how much of February sales are we going to collect? 65%, that's right. And 25% of January sales. And 10% of December sales, right? This making sense to everybody? Tedious, but time consuming. Okay, and then March, we collect 65% of March. This out of the way, 25% of February. And 10% of January. Okay. All right, so now we know how much we can expect to collect in January. If we simply add those 3 months together, we'll get a total January collection. And then, of course, I'll check all these numbers. Okay. So this one looks good. This one looks good. Okay, I think we got it right. So now we know for these 3 months, January, February, March, how much we can expect to collect based on our collections, schedule. Any questions on that first part? Okay, well, the second part is we're going to take the beginning balance in accounts receivable, add any more accounts receivable sales for January, subtract the collections that we just figured out to get an ending balance. We'll do that for all 3 months, and we'll know what's our ending collections in March. So again, cash collected in January, we're just going to put here under collections. February goes below that. And March goes below that. And sales, we can just copy over here, January, February, March sales. We can put right there. Okay, so I'll give you a minute to do that. And then the next question is going to be, what is our beginning balance in accounts receivable? So anybody solve that riddle yet? What is our beginning accounts receivable? Maybe. How'd you get that? So, oh, meaning you added these three? Okay, I think you got that right. And that is pretty ingenious in my view that you figured that out, Drew. Took me a couple years of doing the same problem over and over. I had another way that I figured it out that was very complicated and ridiculous. And this is a much simpler way. So good job. Let's see. So beginning. Was that the total you got? Okay, nice job. So again, Drew got that total by adding these three numbers. So let's think about why that makes sense. What we're trying to find out is what is the accounts receivable balance as of January 1st? Well, we know that this November money and this December money and this December money are all getting collected after January 1st, right? So those were the accounts receivable that were still outstanding at the beginning of the year that didn't get collected until January and February. So simply adding those two together, I mean, those three together, gets us our beginning accounts receivable balance. And you don't even want to know the kind of gymnastics I went through to try to figure that number out. Okay, it's a good job. Now that we have that beginning balance, we add our sales. So in other words, how much more did we sell in January that was on account? Subtract the cash that we collected from accounts to get an ending accounts receivable balance for January. So that gives us 68,432.60. And the ending balance from January obviously becomes our beginning balance for February. Again, we add our sales, subtract our collections, we get 55,929.20. That becomes March beginning balance. Add the sales, subtract the collections, 55,958.95. That is correct. Okay. Any questions? All right, so we're done with 9. Next would be 11, I believe. 14, we did 11. Okay, so 14. Then we got 15. Oh, 15 is easy. And then we'll do 16, which is not super hard. So, okay, we're up to 230. We need a 5-minute break. Anybody? Okay. All right, so problem 14. This looks bad. Page and a half, but not so bad. Okay. They give us a whole bunch of data up here, but the same data are in this table. So we could kind of ignore that first paragraph. They give us sales for 5 months, sales price, which stays the same, direct labor per unit, which changes in March, and the labor rate per hour also changes in March. Okay. The company's planning to add some new machinery in April. Okay. Okay. The new machinery will reduce the labor required per unit. Looks like it took effect in March, but whatever. The labor rate also is going to change at that time. Again, it's changing in March, so doesn't matter. Finished goods inventory is required to be 20% of the next month's requirements. Okay, that matters. So inventory, 20% of the next month. Direct material requires 2 pounds per unit, $3 per pound. Ending inventory for direct materials is 15% of the next month. They give us beginning inventory in January, both for the finished goods and for the material. All right, we're going to make a production budget, direct materials budget, and a direct labor budget. Okay, so expected sales we have up here. Again, we're only doing the first 3 months of the year. They told us that the finished goods inventory is required to be 20% of the next month's requirements. So what would be our ending inventory in January? 2,900? Okay, so that's 20% of February. And then in February, it'll be 3,200, which is 20% of March. So what's our ending inventory in March? What is it? Okay. 3,100. And so Drew took April's production or sales, excuse me, times 20% to get ending inventory for March. Okay, everybody okay with that? So we can add those together to get required units for each month. 700 and okay. And then we have to subtract beginning inventory. So we know ending inventory for January is beginning inventory for February, right? Ending inventory for February is beginning for March. We can just kind of stagger it like that. And they gave us beginning inventory for January, 3,000 units. However, we could have figured that out because if we had taken January's sales times 20%, we would have gotten 3,000. And what do we do with the beginning inventory? we subtract, right? And, okay. Okay, so now we have our production budget. Any questions? Okay, looks good so far. We'll go on to our materials budget. Units to be produced. Where do we get that?
Required production.
Required production right here is our units to be produced. All right. Direct material per unit, they told us 2 pounds per unit. So in this case, a unit of materials is a pound. And so we're just going to put 2. And I think that stayed the same. Yeah, it was just 2 every month. Okay. All right, so we can multiply to get our pounds needed for production. And then desired inventory, they said, was 15% of the next month's production needs or material needs, right? Yeah, 15%. Okay. So in January, we need 15% of February, right? February, we need 15% of March. And instead of making us figure it out, they gave us April production requirements, 31,120 pounds of material. We could take that and multiply by 15%. And we get 4,668. Okay, what do we do with the desired inventory? We add. Okay. 40. All right, so March's beginning inventory is February's ending, right? February's beginning is January's ending. January's beginning, they told us up here is 4,470, so we don't have to figure that one out. We'll just put that number in. And then we can subtract the beginning inventory, right? Any questions so far? Other than when will it end? Okay, and our cost per pound was what, $3? Yep, $3 per pound every month. We can multiply and get our materials costs per month. Okay, I do hope these numbers come out right. Let's double check. 89,310, 89,790, 95,094. All right, that is all correct. Okay. Anyone need additional time on that? All right, so moving along, we got our labor budget and we will be done with this problem. Units to be produced. Again, we already know that. You can just copy it from one of the previous tables. How many labor hours per unit? 3? Oh yeah, this is the one that it starts out 3 and then changes to 2.25 in March. So 3, 3, 2.25, and then I think it's 18 January and February, and then 21 for March, right? Mm-hmm.
What would be an instance in why that would occur? Because it does mention that the labor hours are reduced. But they,
Yeah, so in this example, what they're saying is in April, they're getting this new machine. So the workers won't have to work as many hours because the machine makes things more efficient. But the machine requires a higher level of skill. So they have to either train the employees and pay them more or bring in employees that already have those skills. So that's the thinking on this one. Why we're seeing these changes start in March when the new machine doesn't come until April, that I don't know. But that's the basic explanation. Good question, Joseph. Okay. Yeah, okay. So now we just multiply. Right, we take the 14,900 units for January times 3 hours per unit. Gives us 44,700 hours times our $18 rate. 804,600. We do that for the other 2 months. Oops. 40, what did I do? 44,400, okay. Times 18, 799,200. Okay, then in March, we have the different number of hours. So we get 35,775. And then the different rate of pay, 751,275. Oops. Okay, let's check those final numbers. Okay, that looks good. All right, so we're done with 14. So 15 is actually pretty quick. 16 is not too bad, so I'm going to say it'll take us maybe another 10 minutes. Everybody okay with that? Okay. All right, then we'll be done. So here, it asks us to identify which budgeting document contains these pieces of information. We don't really need this table here, in my opinion. So just think, if you wanted to know how much cash the company had, which budgeting document would tell us that? Yeah, makes sense to me. So let's put cash budget for A. Now I'm just going to get rid of this table here. Don't have to scroll. Accounts receivable. What document would tell us our accounts receivable? Cash collection. Or I'm trying to think if they call it cash collection or cash. Yeah, I think it is cash collection schedule. That's right. How about the raw materials inventory? Yes, I think direct material budget. We'll double check the wording, but it's something like that. How about computers? Yeah, capital. Sometimes they call it capital expense budget, sometimes capital asset budget. And accounts payable. Yeah, cash payment schedule. Okay, let's check these. And we got cash budget, cash collection schedule, direct materials budget, capital asset budget, cash payment schedule. I think that's exactly what we said, isn't it? All right, so that's it for 15. Any questions there? All right, we'll go on to our final one, number 16. So this is a variance analysis. And let's see, this is a static budget based on sales of 25,000 units. We see the static budget in this column, although it's blank. So first thing we're going to have to do is fill that in, figure out what the static budget was. Then we're going to adapt that based on 6,000 units sold, and that will be our flexible budget. We're then going to compare the actual results with the flexible budget. By the way, the actual results that we see in this column is the same as the actual results in this column. But when we compare flexible budget and actual results, we will figure out how much variance there is and whether each is favorable or unfavorable. Okay. Again, let's start by just creating our static budget. So they told us this is based on 5,000 units. So we'll put units 5,000. And we really don't need this table up here because that information's already been copied down. So let's just do like that. Okay. So if we know our actual results where we sold $150,000 worth of product. We sold $150,000 worth of product, which was favorable by $25,000 compared to our static budget. Then what was the revenue we had for our static budget? 125,000? That's correct. I don't know what's going on with that. Somebody didn't pay the bill, apparently. Right, so if our budget was 125,000 and we were 25,000 more revenue than that, we were 150,000, right? See how that works. Now remember with costs, it goes the other way. So it says our costs were unfavorable by 12,800. These were our actual costs. So what were our budgeted variable costs?
90,600.
Actually, we have to go the other way. Yeah, 65,000. Right? Because unfavorable cost means we were higher than we wanted to be. We have to subtract. Okay, and so our fixed expenses were $300 unfavorable. So what was the budget? 70,000, very good. All right, and our net income was 11,900 favorable. So what was our budgeted income? Yeah, negative 10,000. Right, because if you take $1,900, the actual, oops, 1,900 minus the 11,900 favorable, we had budgeted for a $10,000 loss. Okay, so now we know our static budget. Any questions on that? In the flexible budget, again, we're basing it on the 6,000 units that we actually sold. So we know we brought in 150,000 in revenue. What should our sales have been for 6,000 units? How can we figure that out?
Track.
127,200.
That's right. Okay, so we're going to take the budgeted sales revenue divided by the budgeted number of units, and that'll give us our sales price. $25 per unit. Okay. Then if we multiply that by the 6,000 units we actually sold, 150,000. Which makes sense if we didn't change our sales price, then our flexible budget, which is based on the number of units we sold, should match our actual revenue. However, we don't know what's going to happen with the costs. So we have to use a similar approach here, kind of the same approach really with costs. If our variable costs were 65,000 based on 5,000 units, we'll do the same thing that Drew just mentioned. We're going to divide it by the 5,000 units in the original budget. So that means we had a $13 variable cost per unit. Now we multiply that by the 6,000 we actually sold. And we come up with 78,000 is what our variable costs should have been according to this flexible budget. Make sense? So divide by the budgeted units, multiply by the actual units. Although with fixed expenses, we don't do that, obviously. They're fixed. So let's go ahead and say 150,000 of sales minus 78,000 of variable costs and 70,000 of fixed costs leaves us with a $2,000 net income, right? Okay, so now we have a completed flexible budget. We can compare the actuals with the flexible budget and get our variance. So what's the difference on variable expenses? 200? Are we favorable or unfavorable compared to the budget? Favorable, because our costs were lower than the budget said. What about our variance on fixed? 300. And are we favorable or unfavorable? Unfavorable. Okay. All right. Then one thing we could do is say, if our variable expenses were favorable by 200 and our fixed were unfavorable by 300, the difference should be $100 unfavorable, right? And that actually is right, because according to the budget at this level of sales, we should have made 2,000 and we were $100 under that. Okay. And we're done. Questions? Elvie?
There are questions about different problems.
About different problems? Okay. I'll stop recording. Everybody can go, and then I'll answer your questions.